What if I told you that over the last 150 years, the real, inflation-adjusted return on housing and stocks was almost identical? A groundbreaking study of 16 advanced economies found that both asset classes delivered around 7% per year after inflation. So if the long-term destination is the same, why is the debate so fierce? Why does one path, the path of property, feel so much safer, so much smarter, and so much more real to so many people? The answer isn't in the spreadsheets. It's inside your skull. It's a story of powerful financial tools colliding with ancient cognitive biases. Over the next few minutes, you're going to learn the one-word secret that explains nearly all of real estate's magnetic pull. We will then dissect the 3 major mental traps your brain lays for you when you compare a physical house to a digital stock portfolio. We will expose the hidden costs that evaporate profits and turn passive income into a part-time job. This isn't just another stocks versus real estate video. This is a deep dive into the financial psychology that governs the biggest decisions of your life. Understanding this framework is critical because getting it wrong doesn't just mean a suboptimal return. It means you could be misallocating the largest chunk of capital you will ever control. You could be choosing an asset class that is fundamentally mismatched with your personality, your risk tolerance, and your life goals. You might be signing up for a high-maintenance business when what you really wanted was a low-effort investment. By the end of this video, you will see both assets not for what they feel like, but for what they truly are. Different tools with different psychological price tags attached. Let's start with the engine of real estate wealth: leverage. It's a simple concept that has profound effects on your returns and your psychology. Leverage means using borrowed money to control an asset worth much more than your initial investment. When you buy a house with a mortgage, you're not just buying a place to live, you're executing a leveraged buyout of a major asset. The bank puts up 80% or more of the capital, but you get 100% of the control and, crucially, 100% of the upside from appreciation. This is the fundamental asymmetry that stock market investing typically lacks for the average person. Here's how the math warps your perception of returns. Imagine you have $100,000 to invest. Investor A uses it as a 20% down payment on a $500,000 house. Investor B puts the full $100,000 into an S&P 500 index fund. In 1 year, the housing market has a decent year, and the property appreciates by 5%. That's a $25,000 gain. But you didn't invest $500,000. You invested $100,000. Your return on cash is a whopping 25%. Now, Investor B has a great year in the stock market, which returns 10%. Their profit is $10,000 for a 10% return on cash. See the difference? A modest 5% asset gain became a spectacular 25% personal return, more than double the stock market's great year. This is the leverage magnifying glass. This amplification of returns is psychologically intoxicating. It makes you feel like a financial wizard. You took a normal, even boring market movement and, through the magic of leverage, transformed it into a personal windfall. This feeling is a powerful driver of behavior, encouraging more investment in the asset class that provides this dopamine hit. It's not just about the numbers, it's about the narrative you can tell yourself. The market went up 5%, but I made 25%. This sense of agency and outperformance is something an index fund investor rarely, if ever, experiences. Now for the first mental trap: tangibility bias. Your brain evolved over millennia to deal with the physical world. It trusts what it can see, touch, and stand on. A house is the quintessential tangible asset. It's solid. It has weight. It provides shelter. This physicality creates a profound, often subconscious, sense of safety and permanence. Stocks, on the other hand, are an abstraction. They are digital entries on a server, flickering numbers on a screen. Your brain has no evolutionary framework for this. so it perceives the intangible as riskier and less real, even if logic dictates otherwise. This tangibility creates a powerful illusion of stability. Because you don't get a daily quote for your house's value, you're shielded from its short-term fluctuations. There's no ticker on your living room wall flashing red when a comparable home sells for less, or when interest rates tick up. This lack of constant negative feedback makes real estate feel incredibly stable. You mentally mark its value at what you paid for it, and only update that number upwards when you see positive news, creating a ratchet effect in your mind. This brings us to the second mental trap, which is the curse of the stock market: myopic loss aversion. Behavioral economists have proven that humans feel the pain of a loss about twice as much as the pleasure of an equivalent gain. Myopic loss aversion is this principle on overdrive. It's the tendency to feel these losses more intensely when you are forced to check on your portfolio frequently. The stock market, with its 24/7 news cycle and real-time tickers, is perfectly designed to trigger this pain. Every time you log in and see red, your brain registers a threat, causing stress and encouraging you to make poor, short-sighted decisions, like selling at the bottom. Now, contrast these two experiences. The stock investor is on an emotional roller coaster, their mood tied to the daily whims of the market. They see their net worth drop by 2% in a single day, and it feels like a personal failure. The homeowner, meanwhile, sips their coffee, completely oblivious to the fact that their home's theoretical value might have also dropped by a similar amount that day. One experience is high stress and requires immense emotional discipline. The other is calm and requires no discipline at all, because the feedback mechanism is broken. This isn't a fair fight. The final psychological bias is called the wealth effect, and it's perhaps the most counterintuitive. Landmark research by economists Case, Quigley, and Schiller found that you are far more likely to increase your spending when your house value goes up than when your stock portfolio does. $1 of new housing wealth leads to significantly more consumption than $1 of new stock wealth. Why? Because, like tangibility, the housing wealth feels more real and permanent. It's tied to your community, your identity. You see your neighbor sell for a high price, and you instantly feel richer and more confident. That 401k statement, however, feels like distant monopoly money that you can't touch for decades. This behavioral quirk reinforces the entire cycle. Because you feel richer from your housing gains, you act richer. This action makes the wealth feel more concrete, which in turn reinforces your belief that real estate is the superior wealth-building tool. It becomes a self-fulfilling prophecy rooted in psychology. The stock market's gains, by contrast, often fail to penetrate our daily decision-making, remaining abstract and segregated from our real lives until the day we retire. The wealth is there, but the feeling of wealth is muted. So far, it sounds like a slam dunk for real estate. But we've only looked at the psychological upside. Now, we must confront the harsh mathematical reality of its costs. The tangibility that makes you feel secure comes with a hefty price tag. Imagine you're a landlord, and you've just collected a $2,000 rent check. You feel great. But that money is immediately attacked by a swarm of hidden expenses. This isn't a slow drip, it's a torrent. Before you see a dime of profit, you have to feed the machine. This is the part of the equation that euphoric new investors almost always underestimate. Let's quantify this financial drag. First, maintenance. The rule of thumb is to budget 1% to 4% of the property's value every single year. For a $400,000 home, that's $4,000 to $16,000. Next, property management. If you don't want to deal with tenants and toilets, a manager will gladly do it for 8% to 12% of your monthly rent. Then there's vacancy. You won't have a tenant 100% of the time. The U.S. average vacancy rate hovers around 7.8%, meaning you can expect to lose nearly a month of rent each year. These three costs alone can easily consume 25% or more of your gross rental income before you've even paid the mortgage, taxes, or insurance. And the costs are highest when you enter and exit the market. Transaction costs in real estate are astronomical compared to stocks. To sell a property, you can expect to pay 5% to 10% of the total sale price in commissions, closing costs, and other fees. On our $500,000 house, that's $25,000 to $50,000 vanishing in an instant. To sell $50,000 of an index fund, your cost is typically zero. This friction means your investment has to appreciate significantly just for you to break even on a sale, a hurdle that simply doesn't exist in the stock market. Finally, there's the cost of illiquidity. Your equity in a home is not like cash in the bank. It's locked up. If you face a sudden financial emergency and need cash fast, you can't just sell a bedroom. You have to sell the entire asset, a process that can take months. Or you can borrow against it with a HELOC, which involves fees and interest. A stock investor, by contrast, can liquidate a portion of their holdings and have cash in their bank account within days, often with the tap of a button. This lack of access can be a hidden cost when life happens. Let's run a thought experiment. The tale of two neighbors. Both start with $100,000. Neighbor A buys a $500,000 rental property. Neighbor B invests their $100,000 in a low-cost S&P 500 index fund. We fast forward 25 years. Neighbor A has diligently managed their property. They've dealt with leaky faucets, tenant turnovers, and rising property taxes. Their property has appreciated at the historical average of 5.4% annually, and their tenants have paid off the mortgage. The house is now worth over $1.8 million, free and clear, a huge win. But over those 25 years, they've paid roughly 30% of their gross rent to maintenance, management, and vacancy. Neighbor B simply held their index fund. With the historical S&P 500 return of 10.26%, their initial $100,000 with no extra work has compounded to over $1.1 million. The real estate investor comes out ahead in absolute dollars, but the stock investor achieved a seven-figure net worth with virtually zero effort or additional costs. Which one was the better investment? This brings us to the great myths of real estate investing. The first is that it's a form of passive income. This is a dangerous fantasy for anyone who hasn't actually done it. Direct property ownership is a part-time job. You are a business owner. You have customers, who are called tenants. You have a physical plant, which is the property. You have marketing, accounting, and legal compliance. Even if you outsource the day-to-day work to a property manager who takes 10% of your revenue, you are still the CEO who has to manage the manager. The second myth is that real estate always goes up. While it's true that on a long-term national level it has appreciated, it is not a straight line, and it is not guaranteed. More importantly, the real inflation-adjusted appreciation of housing is shockingly low, historically around 1.5% to 2% annually. Let that sink in. The vast majority of your home's price increase is often just keeping pace with inflation. The real wealth isn't generated by appreciation. It's generated by leverage amplifying that small appreciation and by your tenant paying down your mortgage, which is a form of forced savings. You're not a genius for picking an asset that went up. You're a genius for using the bank's money. This leads to the biggest, most counterintuitive myth of all, that real estate generates much higher returns than stocks. We started with the answer from that 145-year study. Total real returns are nearly identical at around 7% per year. So why does the myth persist? Because of the leverage and psychology we've discussed. People compare their levered 25% return on cash from a property to an unlevered 10% return from the S&P 500 and conclude real estate is superior. They're comparing apples to oranges. They're forgetting the massive difference in risk effort, and costs. The journey is completely different. One is a smooth, steady, high-effort climb. The other is a volatile, low-effort rocket ride. The final altitude might be the same, but the experience couldn't be more different. So, what is the real takeaway here? It's that the crucial difference isn't mathematical, it's behavioral. Real estate, for all its costs and hassles, provides a powerful behavioral framework. The large barrier to entry, the illiquidity, and the monthly mortgage payment create a system of forced discipline. You are forced to save, forced to think long-term, and psychologically shielded from volatility. Stocks offer a mathematically purer, lower-cost path to wealth, but they demand a level of emotional discipline that many people simply do not have. They provide a loaded gun of liquidity and a constant temptation to react to meaningless, short-term noise. The choice between real estate and stocks is not about finding the universally better asset. The data shows that over the long run, they deliver remarkably similar results. The real question is a personal one. It is an audit of your own psychology. Which system are you better suited for? Do you thrive with the tangible, high-involvement, forced discipline of property? Or do you have the iron-willed emotional control to embrace the intangible, low-cost, high-volatility world of the stock market? The goal is not to pick the superior asset, but to pick the one that neuters your own worst impulses and leverages your strengths. Stop asking which investment is better and start asking which investment makes you a better investor.